Hello friends, continuing our financial planning video series. Today I will talk about the importance of planning your finances through budgeting process. Why budgeting is important is that basically you need to differentiate between your living expenses as well as your lifestyle expenses. You need to have a balance, and by doing budgeting with all the line items, you will understand how much you can save on a monthly basis, and you can actually extrapolate this data on a yearly basis so that any bonus, interim bonus, whichever comes in, you can plan the finances accordingly. And if you're running a loan, always ensure that only up to 50% of your take home salary is taken as loan. Beyond that, what happens is that if you go for a higher loan, it will impact your personal finances in a bigger way, where you will not be concentrating on investments. And second thing is that people are getting messages left, right, and center on all the FinTech money app to get loan in a flash of a second. So don't fall prey to it, because that will always put you in debt trap for a perpetual period, and that is not required. Basically, you should take loan only if it is for a long-term asset, something like a home loan. For other assets, max plan it through your investments, because every year you will have an option to replace your white good, or you will be buying clothes, paying for the fees and other tour expenses and everything. If you can budget it by allocating different funds for all these goals, rather than going for loans and getting into a loan trap. And budgeting also helps you how much you can save every month, so that you can always look at incremental savings by doing an SIP as well as SIP top up or an additional purchase at different point in time. You can get the opportunity to participate in the market at different levels, and also it will give you a good diversified portfolio. And budgeting plays a very crucial role, because that will ensure that your finances are very much in order. Fine. And then now look at the importance of asset allocation. As you know, you should not keep all eggs in one basket. You should have to have a diversified portfolio. When I mean diversified portfolio, you should have a portfolio which are not correlated between each other, which are perfectly uncorrelated. For example, an equity market in India and equity market abroad is completely uncorrelated. Similarly, if you have investments in a commodity, something like a gold, silver, or any other precious metal, or you should also have a diversified portfolio in debt also. It is not only about short-term funds. You should have medium-term funds, long-term funds, a combination of NCDs, which gives you regular interest payment. And there are multiple options available to you with different frequencies. This gives you a broad perspective. If you have a 3-year goal and that money is required at that point in time, you can always choose an instrument which can give you the stable cash flow and with the return of capital. Those type of investments you need to plan. Similarly, when you are planning for long term, it has to be equity, because that is the one thing which can beat inflation and compound your wealth. That is highly required. And for a well-diversified portfolio, we would suggest having, if you are an youngster, ideally have 50 to 60% in equity. And for medium-term goals, have a combination of multi-asset or a combination of equity with international equities and other things. Have for short-term, have 10 to 15% in debt and also 5% in cash. By having a asset allocation in that parlance, what it will help you is that it will help you to have a good investment experience and keep investment as per your goals. Because always remember, equity is for long term and debt is for short term. So don't plan debt for long term. Of course, your provident fund is there for long term, your employee provident fund or a PPF, but leave alone that. The other things can be for short term, because as India's economy is keep growing, the interest rates will fall down. So eventually you will not have the opportunity to fight inflation. So consider Any investment more than 5 years only in equity, and for a shorter time, say anywhere between 3 months to 3 years, you can ideally look at different debt investment, and 3 to 5 years can be multi-asset and others. So by diversifying this portfolio and mapping each investment to your goal, you will always have a good investment experience with good tax efficiency, as well as it will help you not to worry about the short-term market. You can stay invested as per your goals and as per your asset allocation. Fine. In the next video, we will talk about the importance of power of compounding with live examples to make you understand how this compounding is not well understood by investors at large. Thank you.